Welcome back to the Warlords of Wall Street. Today was an interesting day, to be sure. We started off early with some numbers from the Chicago Board of Options Exchange, the CBOE. It publishes a volatility index, and that index essentially tracks, it's an important gauge, it tracks the put volume in the market. On a given day and over the course of a given period. Now, the reason why they're tracking put contracts is when you're dealing in the options contracts, puts are considered a negative indicator that somebody doesn't have great faith in the market, at least in the short term. A call is considered more of a positive look, but this thing tracks the negative puts. And it started the week at, unsurprisingly, north of 22. It's gone as high as 28s and 30s over the last few months. So when it's that high, you can bet there's some ugly sentiment out there about the direction what the market is going. When it falls below 19, that's considered extremely positive, and it's only been significantly, not even significantly lower than that on but so many occasions. But when we're in this range, this is kind of a sweet spot. And I find it interesting that we've spent the last 3 weeks really kind of having to ride the dragon here with all the hot inflation information that's coming out. And it just seems like all of a sudden everybody is digesting that, has decided that it's only but so bad. Maybe the market, which is forward-looking, has decided as a whole, all right, we think we've pulled it back just enough, an extra 3%, maybe we're fine here. And that might explain a little bit of why the sentiment is changing for the boys that are trading options up on the Chicago Board of Exchange. On a personal note, options, I hear it from an awful lot of young investors that in this modern day of FanDuel and everybody doing a lot of gambling, and it's being made easy. For a while during the pandemic, when everyone was getting some cheap money or free money in the mail, it turns out that a lot of people, young folks that were getting into the market for the first time, were playing some, they were playing aggressively and literally gambling, because that's what an options contract essentially is. They're not meant for amateurs. It's tough enough to pick a stock, as we try to do on an individual basis, based on the fundamentals, the technicals. There's a lot of work that goes in trying to make a decision on what is a good investment. And when you are well seasoned at that, and you're still working your hind end off to try to beat the market, the option, on the other hand, at least when you're buying a stock and you're going long, as they call it, we have at least the advantage of time to be proven right. And if we've done all of our work, eventually we are. However, an options contract is a different kind of animal. It's literally a bet. And that bet has a time frame attached to it. That contract has an expiration date. And you're paying for the privilege of either putting a stock to someone or calling it away from someone. I'm not going to get into the weeds about all the different variations of the contracts that you can do, but be wary of all these so-called geniuses on the YouTubes claiming that they have a system and you're going to get rich by leveraging your money. And it's true that when you are absolutely right on an option and you've been able to leverage, because that's what an option contract lets you do, it lets you leverage your dollar significantly. And if on the rare occasion that you are right, yeah, you'll make some impressive money. But the reality is most people lose their hind ends on it, because you not only have to be right about what you're buying, you have to be right about the direction it's going in, to a greater or lesser degree, within a certain amount of days or weeks or months, as the case may be. That's a very difficult thing to do. So I'm going to caution those that are new to the investing is to grab a book written about or by Warren Buffett. That's the kind of mentality you need to take to the market. this isn't a game for gambling. It just really isn't. And once you get really good at picking stocks, you know how to rip apart a financial, and you can tell me where you think a particular company is going because its management is right, its product mix is right, the timing in the market and the economy is right, its financials are right, everything, all the stars have lined up, and it's a decent deal, pretty good valuation, all things being equal. If you can tell me all of that, then, and you have a track record of being right about 6, 7 out of 10 times, well, maybe you are clever enough to start trying to decide, once you've played a given stock or two so many times, been right so many times, you feel like you know it, well then, maybe it is time for you to play options. But up until then, for you beginners, leave them the hell alone. The interestingly today, rates retreated a bit. And that was a pleasant thing, since the 10-year just yesterday broke through the 4, and it was even this morning tickling 4. But as the day went on, it gave back just a little bit, and that was a very pleasant surprise. We want to try to see this 10-year, in my humble opinion, in the charts that I'm looking at. I don't want to see that thing get any higher than about 4.5. I'd like to see it stay at a 4.25 at the max. That's something that we saw going back to the peak of the market not so many months ago when it spiked. From a technical standpoint, I want to see it stay there. If it does, then I think our soft landing is still in play. If it stays there, then the inversion that we see in the short-term yield curve between it and the 2-year doesn't bother me as much as it would. If it continues to narrow, that ends up becoming a problem, believe it or not, at a certain point. The market responded because rates retreated, and they are kind of joined at the hip. One goes up, the other one goes down. So the market responded, and it stayed fairly strong for the latter half of the day, closing pretty near its highs, if not at its highs. That was nice to see. Our regional bank fund that we were confessing yesterday that we got stopped out of, and we came back by losing 5% on it. That's our stop loss mechanism. We will not jeopardize more than 5%. We try to take the ego out of it, and so we always set an automatic stop loss on anything we buy at 5%. If you're wrong, you're wrong. And if it tends to fall below that, if you liked it 5% higher than that, well, you got to love it if it's 10% lower than that. Why not buy back in? If you thought you were right at that price and all of your research supported it was a good decision, all your research is going to support coming in at a significantly lower price. And sometimes you can just be wrong. Nobody's perfect. I like to think I am, but no one's perfect. We picked up, as we mentioned yesterday, we picked the position up again after we got stopped out. We came back in at 22.30. Looks like it jumped up over the last day or so. We got $1 of that $1.25 that it took from us the other day when I was laughing, the market giveth and it taketh away. So we got most of our money back just in a day. That's very nice. Now I want to get the rest of my money back, and I want to make the 5% I got into this trade for to begin with. So we're going to be very cautious going forward with the regional banks and that leveraged ETF. Meta had a bit of a comeback. It jumped about 6%. That was a very pleasant surprise. I think that they were overselling it a little bit, but I think between all the news that's been coming out with the AI and what have you, I just really don't think you can argue that Meta looks like a fine value at this point. Its PE is right. Its cash flow is right. All of the fundamentals look good to me. And so long as they remain disciplined about their spending in the metaverse, and it seems that they got religion about that, we should be good with that, and it's pleasing to see it start to roll back. Those of you that we were talking to the other day, we were saying that right around that 170, 71 range where it was a few days ago may not be a bad entry point. And it turns out, had you followed us on that, you would have already made a little bit of money on it, which is always nice. The Tesla was up just a little bit today, which was also pleasant to see. It looks like the market is already trying to figure out if Elon is deserving of some forgiveness. Apparently he is, because when you really break down all the numbers, they're still they are the rabbit and everyone else is chasing them. I make no contention about that. It turns out that our timing on picking up Pioneer last week at the 201 mark is paying off. Looks like we're already over 5% profit on that. That jumped nicely today as well. And our Intel, which is an ugly, bottomless pit of stale money for a great many years. We just decided we couldn't take the fact that it was in the 24 and 25 range, so we decided to take a little taste. And it turns out that we've made about 4% in the week on that as well. You can't go broke making $1 here and there. And we want to be aggressive about protecting our profits. So when we get maybe another 50 cents out of Intel, or for that matter, a couple more percent out of any of these, we're going to come up behind them with a trailing stop loss so that we can go ahead and, if we've got momentum and maybe the market is showing us it's going to give us a little bit of love next week, we can squeeze a little more money out. And if then it retreats, then at least we can protect what profits what we've made. So I highly recommend the trailing stop loss as well. Once you've got maybe up 5% in your position, start looking to protect it. Try to protect that money. There's nothing wrong with that. Speaking of free cash flow, when we were mentioning Meta, this is another one of those analytical tools that should be in your quiver. Today, especially with the market as volatile as it is, free cash flow may be more important than it has been in a very long time. People talk about it a lot, but I'm guessing that most people don't exactly know what free cash flow is, and I'll try to make it as simple as I can. Free cash flow is essentially all the cash that's left over after the company pays all of its working capital expenditures, all of its current obligations in the course of the year, all of the obligations on its fixed assets. And fixed assets, what is a fixed asset? I'm glad you asked. A fixed asset is essentially a giveaway. It's fixed. Buildings are fixed assets. Equipment. Ford, if you can imagine a factory, you've got the building and you've got all the equipment in there. It's a fixed asset. They're paying on that. That's what their bonds are for. They didn't go down to their local Bank of America and borrow $1 billion to go buy a building or pay for all of the automated equipment and what have you that's in the building. So by the time you're all done paying all of your bills, you've got everything covered. If the question is do you have any cash left over? And it's always good to have cash left over after everything. And this isn't unlike the current ratio that we talked about a couple of days ago. The current ratio is basically the company's cash position to cover all of its obligations in the course of its operating expenses in the course of a year. Well, the free cash flow is essentially that plus covering all the fixed asset expenses as well. And what we want to see is when the company is all done taking care of all of its bills and what have you, we want to see money left over, cash still on the table. And I want to see that to be better than a 1-to-1 ratio. The more cash flow that company has, the stronger it's a dead giveaway, the stronger its operations are. Another little cheat when you're looking at the fundamentals and you're looking at numbers, the last little tidbit I'm going to give you is that you want to be, revenues are easy to fake. There's a lot of ways in which you can manipulate the earnings per share, but sales going up or down is hard to manipulate. You're either going up in sales or you're not. So we always like to look at those companies that are, well, regardless of the stage they're in, whether they're in a growth stage or they're just the McDonald's of the world, we want to constantly see progression in the sales categories. We want to see those on the buy line. We want sales to increase. That tells me that you're healthy. And I'm always remarking to those that are working our financials in the back and doing their wizardry to turn around and say, how is it that this company's sales are down 2%, but its revenues are up 1%? How is that possible? Accounting voodoo. And you need to be careful about that. But that's part of this journey, is to learn what to look for, because there's a lot of games being played out there by companies creatively. They're not illegal, but they are very creative, and they can be deceptive about a company's health if you don't know where to look and the questions to ask. So we're going to leave it there for today. We appreciate your continued interests. Keep your powder dry. Take your profits where you can. Good luck.